If you feel clueless about how to manage your personal finances, this video is for you. Hi, my name is Kayla, and this channel is all about building a life of freedom through financial freedom. Good personal finance management is not just about the numbers. It's about security and freedom. Having less stress, achieving your dreams, and taking control of your future. This video is your one-stop shop for personal finance. It equips you with everything you need, from planning and goal setting to protection from unfortunate events and picking the right tools. If you fail to plan, you plan to fail. Without a plan, it's easy for your money to slip away and leave you wondering where it went. Planning helps you to prioritize your spending and allocate funds towards your goals. It helps you make more informed financial decisions at every juncture and take better control of your money. Planning takes place across a few areas. Planning for immediate living expenses, planning for future expenses and goals, and planning whether and how debt should play a role. Planning for immediate living expenses. Money goes in and out of your accounts every day, so knowing how much and where your money is going and why is important for staying in control. Budgeting allows you to do so. It's not just a numerical exercise, but a process that gives you insights into your spending behaviors, clarifies what you really value, empowers you to confidently make responsible spending decisions, and allows you to be present and to enjoy life more because money worries are not taking up your mind space. I have created a simple 5-step process on how to budget. In brief, step 1 is to understand your money inflows and outflows. Step 2 is to clarify the motivations behind your expenditures and prioritize what you truly value. Step 3 is to plan out how much you can spend and the savings rate that you are targeting. Step 4 is to track your spending and make adjustments to your spending behavior to stay on track. And step 5 is to review and update your spending and saving plan to align with changing income, needs, wants, and goals. To learn more about budgeting, check out my YouTube video where I deep dive into these 5 steps. Planning for future expenses and financial goals. We all have something we want to save for, to spend in the future. Be it a wedding, home renovation, down payment for a house, university education for your kids, a travel the world fund, or a retirement nest egg. Looking ahead into the future and having a concrete financial plan to achieve your dreams will make them feel within reach. Here's how. Set SMART goals in your plan. Your goal has to be specific. Clearly define your goals. For example, instead of saying you want to save for a down payment, you can say save $10,000 for a down payment. Your goal has to be measurable. Quantify your goals to make it easier to track progress and know when you have reached the finish line. In the example of the $10,000 down payment, you could use a monthly savings tracker to track your progress. Your goal has to be attainable. Goals should be realistic, so set a realistic monthly savings goal based on your income and expenses. Your goal has to be relevant. Ensure your goals align with your overall financial vision. Review your plan if there are changes to your financial situation and goals. If your circumstances change and you need to buy a bigger house along the way, you will need to update your savings target. For example, increasing the goal of $10,000 to $20,000. And lastly, your goal has to be time-bound. Set a deadline for achieving your goal. For example, you may want to save $20,000 for a down payment for the house in 3 years' time. Also, you can consider investing. The power of compound interest can help you grow your money exponentially over time and help you reach your financial goals sooner with less capital. For instance, if you need $20,000 for a down payment in 3 years, saving $540 a month and earning a 3.85 interest rate per annum, assuming compounded annually, will give you $20,198.04 at the end of 3 years, with only $19,440 as your contributions. However, do take note that cash you will need to use within a year or two should not be invested into stocks that could go up and down. Use secure options like high-yield savings accounts or fixed deposits to keep it safe and readily available. Money you won't need for 10 to 20 years can be invested in stocks, which can be riskier but also offer the chance for higher returns over the long term. Planning whether and how debt should play a role. There is good debt and bad debt. Good debt helps you build assets and improve your future. It increases your net worth in the long run. Examples include mortgages and business loans to start or grow a business. Such debts typically have lower interest rates, longer repayment terms, and contribute to your financial goals. On the other hand, bad debt hurts your financial situation. It increases your liabilities and makes it harder to save. Examples include credit card debt or debt for depreciating assets like expensive cars or electronics. Such debts typically have higher interest rates and shorter repayment terms and do not contribute to your financial goals, which means that you are basically accumulating debt without any real benefit. Good debt is an investment in your future, while bad debt is a burden. Aim to avoid bad debt and use good debt strategically to reach your financial goals. For instance, if you can get a higher return on your cash compared to the interest rate of your mortgage, it may make sense to stretch your mortgage payments and free up cash flow for the higher return. However, consider other factors like whether you are someone who prefers to live without the burden of any kind of debt or whether you want to build equity in your home faster, in which case it would make sense to pay it off as soon as you reasonably can. Unexpected and unfortunate events can wreak havoc on your finances. Such events include job loss, medical illness, and accidents, and may cause a break in your cash flow or require large sums of money. To prevent such events from creating a dent in your finances, requiring you to dip into your funds for your goals, or forcing you to take on debt to cover for the expense, you need financial safety nets in place. Having an emergency fund. An emergency fund is your first line of defense. It's a sum of money stashed away that gives you financial breathing room to deal with emergencies. The general rule of thumb is to save 3 to 6 months of living expenses. If your job is less stable, you might want a larger fund to cover potential income gaps. If you have dependents, you might need a larger emergency fund to cover their needs as well. Do note that an emergency fund is not for everyday expenses. Make sure that it is used for true emergencies only. Once you have used a portion of your emergency fund, prioritize replenishing it as soon as possible to rebuild your financial safety net. Your emergency fund should be easily accessible when you need to use it and ideally kept in a high-yield savings account to help your emergency fund grow. Getting adequate insurance. There are several types of insurance covering for specific situations. Health insurance. It covers medical expenses arising from accidents, illnesses, and hospitalizations. Life insurance. It provides a financial benefit to your beneficiaries, such as your dependents, your spouse, upon your death. This can help them maintain their financial security after your passing. Disability insurance. It replaces a portion of your income if you are unable to work due to illness or injury. Car insurance. It protects you from financial liability if you cause an accident, as well as damage to your own vehicle. There is no one-size-fits-all answer to adequate insurance as it depends on several factors. Age. Younger individuals might prioritize disability insurance, while older adults might focus on long-term care insurance. Family situation. If you have dependents, life insurance becomes crucial to protect their financial well-being in case of your passing. Occupation. High-risk professions might require additional insurance coverage. It's important to get adequate insurance coverage. If you are unsure, talk to a professional financial advisor you can trust and who can assess your current life situation, evaluate your needs, and recommend appropriate coverage options. Make sure you understand the terms, exclusions, deductibles, and coverage limits of the policy before signing. Adequate insurance shouldn't break the bank. Aim for a balance between affordability and sufficient protection. Regularly review your coverage as your life circumstances change to ensure it remains adequate. Having diversified streams of income. Job loss, illness, or economic downturns can disrupt your primary source of income. Having multiple income streams creates a buffer. If one source dries up, the others can help you weather the storm and maintain your financial stability. Ways to diversify include starting a side hustle and building passive income streams such as investing in dividend-paying stocks or a second property to collect rental income. Here are some things to consider when diversifying your income. Time commitment. Some income streams require more time investment than others. Consider how much time you can realistically dedicate to each source. Skills and interests. Choose income streams that leverage your existing skills and interests to make them more enjoyable and sustainable. Startup costs. Some income streams might require an initial investment, such as starting a business. Carefully evaluate the costs and potential returns before diving in. Risk tolerance. Different income streams carry varying degrees of risk. Choose options that align with your risk tolerance and financial goals. Building additional income streams takes time and effort, so start small, experiment, and find what works best for you. Even a modest additional income stream can significantly enhance your financial security and peace of mind. By tools, I am referring primarily to bank accounts and cards that we use to transact, as well as brokerage accounts we use to invest. The wrong tools can be expensive and inefficient. The right tools can be cost-effective and get you where you need to go. Here's a breakdown of why picking the right ones matter. Saving money on fees. Banks and card issuers charge various fees, including monthly maintenance fees, foreign transaction fees, and overdraft fees. Some accounts require a minimum balance to avoid monthly fees. Brokerage accounts have fees such as commissions per trade, market data subscription fees, and inactivity fees. Choosing accounts and cards with minimal or waived fees can save you a significant amount of money in the long run. Maximizing your money. Some accounts offer benefits like interest on your checking or savings balance. High-yield savings accounts can help your emergency fund or savings goals grow faster. Cashback credit cards reward you for using your card, essentially giving you a discount on your purchases. Aligning with your spending habits. Different accounts and cards cater to different spending habits. For example, if you travel frequently, a card with no foreign transaction fees might be ideal. If you tend to overspend, a debit card can help you stick to your budget as you can't spend more than what's available in your account. By choosing the right financial tools, you can keep more money in your pocket, make your money work harder for you, and take control of your financial future. These 3 pillars are the cornerstones of good personal finance management. This is a lot of information to remember, so grab this infographic to keep these points at your fingertips. Download it from the link in the description box.